A unique piece of content this podcast is because we bring you people who wouldn't normally appear in an information field, who don't feel too comfortable speaking publicly. But only hearing from them you'll get the most relevant, the most actual, the most important information of what's happening today in the blockchain industry. And there is a lot of things happening. Inflection point is not too far away. Adoption rate is going to be higher and higher and higher with every day. Today's topic is deep dive into staking. So let's listen to this. Hi, Srikanth. Thanks for joining us from the podcast to talk about staking. This is an important topic and there is a lot of interest to it. So I'm very glad that you have a lot of interesting perspective that you can unfold, and let's just talk about them.
Thanks for inviting me, Dennis. It's always good to speak about staking because I somehow feel staking is the most misunderstood concept, or less understood concept among people. So happy to explain them about the basics.
So let's start unfolding it then. And can you start by giving a brief overview of what staking is and why is it important in the blockchain ecosystem?
So staking is nothing new. You can compare that with your traditional banking. You take your money, give it to banks, they give you some interest rate, right? So similar to that, staking is a process of locking up your cryptocurrency or any asset that you hold on blockchain networks, and in return you receive reward. So this is basically to validate a network, or keep network secure, and then you receive some rewards as a return. It's essential because it provides security, and at the same time incentivizes the participants who are doing it and offers them an yield opportunity as well. So you get the decentralized security and then you get your yield.
Okay, understood. And how has the landscape of staking changed since the early days of proof of stake?
Absolutely. So Bitcoin, the father of cryptocurrency, if I can call that way. So it started as a proof of work, which implies, you have a bunch of players who are utilizing computational power of the machines to mint, or to solve a puzzle, which give them chance to mint Bitcoin. So you're using a lot of electricity, a lot of power, just to solve something and then mint Bitcoin, which solves one side of problem, wherein people who work, or who do the work, gets the reward. But then the other side of problem is we are increasing, with the global warming or the increasing environmental damages that is being done. So there is a need to get an alternative approach, keeping things decentralized. So Ethereum came up with a proof of stake. They've migrated to proof of stake recently, and proof of stake gives you an option. You don't spend as much energy as you spend in POW, proof of work, but you get similar decentralized benefits, and with much lesser capital that you can do. So much better way, in my opinion. But because Bitcoin has been there and you can't change the code, I'm glad that the second best tried to do that, and we are here today.
And what about environmental impact? Because cryptocurrency in general has this question, and staking in particular, I guess. Could you unfold this a little bit?
Proof of stake has been there for a while. So if you see projects like BitTorrent, or peer-to-peer torrents, where I have a file, I share it across people, like anyone across the world can download the file. So file is divided into multiple segments, and then you are connected with multiple peers online, and it is downloaded. So there is this peer-to-peer thing for a while. But then proof of stake landscape has been like, initial days you have Peercoin and NXT, which has simple mechanisms with limited scalability and security features. But with Ethereum coming into play, projects like Ethereum, Solana, Polkadot, technology has matured, introducing better decentralization, or more efficient consensus algorithms, diversify staking options, such as liquid staking, delegated staking. So this evolution has, increased adoption, accessibility, and participation to people in one way. That's how it's evolved.
Okay, okay, understood. And this transition of Ethereum to proof of stake, how did it affect the overall ecosystem of blockchain, and maybe just specifically a staking topic?
Now, I would say Ethereum's shift to proof of stake has been the single most important step towards, POS adoption, because there has been POS systems earlier, and but to see that impact, you need that monumental shift. So Ethereum having 500 to 1 billion market cap, it, somebody of that magnitude, sorry, 1 trillion. Um, so somebody of that magnitude, if they're shifting to POS, yeah, that catches a lot of eyes, developer ecosystem, or everybody trying to see what it is. And then you have a lot of good adoption coming in with Ethereum's move. And then now that ETH has its own ETFs and with Bitcoin ETFs, there is institutional interest coming in. So it increases a lot of adoption. Um, as I told, environmental aspects, and uh, that actually increased overall interest in staked blockchains across. Like you have a lot of layer ones, L1, L2s coming in, so everybody opting it for POS, and then you can incentivize the actors in this space, right? Like communities, you are everything, so you can incentivize your community for that rather than limiting them with a big beefy machine or beefy architecture where they have to spend tons of money. Today they just need a computer or good machine, and then they can earn rewards. So I'd
Mm.
say impact is very huge, and yeah, I mean it is on the positive side for having a mainstream activity.
Okay, thanks. You have very complete answers. I can't think of anything that we need to unfold even more. But let's dig deeper into this, and let's jump onto a slightly different topic, which is liquid stake. And there is a lot of buzz about it. But can you tell a little bit more? Like, why is it becoming a trend, and how does it affect traditional staking too?
You have staking where you lock up your assets. There are different ways. We can discuss that later in the call. But once you lock up your assets, you receive rewards. And then if you wish to opt out, you receive back your deposited capital. But assume, like as I told, this is similar to what you do with banking. You give your bank your money, and then they give you interest. But what if there is a way in which you can use that bank's receipt? Bank gives you a receipt that you have deposited, let's say $10, $20, or so and so money. What if you can use that money to or that receipt to utilize it whenever you need it, or to participate in further beneficial yield generating opportunities? So that is where liquid staking comes in. So there are ways in traditional systems, but it is too complex. You have to you know find some ways to do that. But here, once you stake, that staking platform will give you a liquid staking token, which you can utilize to be part of DeFi ecosystem, decentralized decentralized finance, where you use that token, you do some DeFi activities, earn more yield, or participate in more complex DeFi things and earn better results there. And then whenever you want your money back, you just swap this to actual token that you have. Like for Ethereum, you have Lido, a major player called Lido. So you give them ETH, they give you equivalent ST ETH is pegged to ST, so 1:1. So majority of times you have that. But the only downside risk is you have to trust that player. So here Lido is a good decentralized player, so they have earned that trust. So it is important to trust that player. Otherwise, Lido also depegged for a while before Ethereum withdrawals started to kick in. So people had doubts on a bit on Lido, but seeing their decentralization, or the kind of backing they have, it's peg restored immediately, right? But there are chances that a less well-known player or somebody who does not have that integrity is here, and then you tend to lose that money. So there are downside risks, but the upside is more. Pros are more to utilize that liquid staking.
Let's unfold the security a little bit more then, since you touched upon this. As you said, it's crucial. It's a major concern. But how do you trust the your funds then? What do you need to look at, and what is important for a validator to to do in order to get to certain levels of security, which will be, well, unbreakable?
There's nothing called unbreakable, but we take maximum security precautions so that you minimize the risk almost to zero, but then 0.001 is always there anywhere. So you have that systems that is ready. So let's take generic example where you have a validator and the people who are holding that token delegates to that validator. So here the community, or the people who is delegating token, is trusting that validator. Although the tokens are not transferred in majority of the cases, it is delegated to the validator. Validator will not have any say in withdrawing those assets or anything, but they can still play a different game and then lose all of it. Like if they don't follow necessary security precautions, they will be penalized for slashing or any other ways, and they will lose some stakes. So if you take Ethereum for example, you have part of Ethereum, like for each validator you have 32 ETH, and you have part of it, let's say 8 ETH or 16 ETH, which can be slashed essentially if validator is not following necessary security precautions. So when I say security precautions, they need to run a stable system. Like it can be bare metal server, it can be AWS server, or it can be a good beefy machine at your home, but it needs to have a um, good working minimum hardware requirements that are there. So for Ethereum you have a different requirement, for Solana you have different requirement. So you need to have minimum requirement there, and you need to have good network connectivity so that you don't miss any blocks. Let's say you are the proposer for that period, least you want to do is have network connectivities and not propose any block. So you have to have good network connectivities, and yeah, I mean, you follow all the rules with minimum downtime, and then as soon as there is downtime, take quick fixes. Like you need to have a planned way where if there is a block downtime in your data center that you're hosting, you need to have a backup plan where traffic is routed to your backup node. That's called disaster recovery essentially. So you need to plan all this in advance so that you're not up for surprises. Let's say you miss any of it, you get slashed, and then you will lose all the rewards that you
That's why, as I understand, some companies put forth that their infrastructure is unslashable, right? This is also kind of a buzzword in the area. Is there anything else we need to talk about when it comes to process of validator selection in the proof of stake system, or is there anything to add to what you just described?
So there are two parts of it, in my opinion. One is uh, a project selecting good validator, and a person who is holding token selecting a good validator. Like for project, I would say there's nothing available today in the market to judge if this validator is good historically, but I wish there'll be some um, projects coming up to rate these validators so that I might have a bad day today, and if you visit my ratings you might just feel that I'm a terrible validator, but it could be otherwise, where my historical performance is very good and this is just a one-off day. So you need to have a system where which validator performs good. So even today you can do that to some extent. You go to validators history, see their uptime, historical performance. If you see they're consistently above 99 or 99.5% uptime, essentially they're there trying to do what they are assigned to do.
Hmm.
And then you see, like, you have projects like Ethereum where you do some block validations, or you have project like Gnosis where you do attestations. So you see if they're missing any blocks or missing any attestations, which implies the software and network is also good. So if they're doing all of this, good. And if they're not on any public cloud infrastructure, I don't have anything against public cloud, but because there is a risk that, any public cloud infrastructure, you tend to get shared systems, unless you explicitly ask for a, you know, dedicated validator or dedicated system, you don't get that. So if you have dedicated system, much better. Otherwise, even public cloud servers are also good, but you have to make sure that you have a dedicated system there, and you take all regular backups, you do all the redundancy protocols that I've mentioned earlier. Then that is
Mm.
good option. But because for user to check all of this, it is difficult. You go to your project, you click on your validator, see their historical performance. If they are consistently doing producing blocks or doing attestations, whatever job they're assigned, plus their uptime is good, then I assume that they're doing good for most part of it.
Before we delve into more deeper topics like multi-chain and such and restake and all, let's do a quick break for some of those who are technically advanced and understand this, and also give a little bit of a breather to those who might be getting a little bit lost. And let's maybe, like how I usually get when I get into a new topic, I want somebody to explain it to me like it's a 3-year-old. Can you explain to me now, like I'm a 3-year-old, what the validation process actually is, and how it works? Maybe there is a simple life analogy or something like that.
So again, I call these as nodes. So you have different type of nodes. Like if you take a game, you have continuous data that is coming in from the game. So you need some nodes who maintain all of this data outside the game, and you have that reliably outside, right? So for validators, if you take Ethereum as example, you have various responsibilities for each validator, right? Like you have to create and validate each of these transactions. Like you have n number of validators, there'll be one validator who gets this chance to validate or propose a block. That validator will propose a block, and rest of the validators agree, come to a consensus that this block is correct, and then they add that block into their system. So on an average, on Ethereum, let's say you run a validator, you get chance to propose a block every, let's say, 1 month,
Mm.
and it differs from project to project. So you are that core part of the protocol where you propose that these are the transactions, or this thing happened on your blockchain, and everybody agrees to that. So it's impossible for all validators to propose at the same time and agree to that. So that's where validators are very really.
And node, in a nutshell, just for those who are not familiar with the term, what is it?
Node is a machine, like you can think of it as your PC computer, or
Mm.
any piece of software that you run on a AWS or any public cloud bare metal. So any system is a node, but what type of node it is depends on the type of project that you run it for. So for Ethereum, you have validator nodes, light clients, or full nodes. So full nodes store all the data, all the historical data. Light clients are only responsible to make sure that they have all the necessary data to prove that this transaction hash is available on this blockchain. That is true. So you have projects like storage networks, or anything related to storage. So they store all your data, and even there you have a light node which does not store all the data, but they have links to crucial data or last n days of data. So it depends. Node definition varies from project to project, but for validator nodes, their job is to validate all the transactions or logs on that project and publish them onto the network. That's the main key role.
Okay, got it. And you mentioned this in the very beginning, but let's also recap, since we are talking about validators and nodes already now. Rewards, like we let's recap a little bit where rewards come from real quick, because again we talked about this, and more importantly, let's unfold what does affect the reward rate.
So as I told, when you stake a token or when a validator is there or when you delegate your token, their responsibility is to secure that network with that stake. So in proof of work, you have that work or the energy consumption there behind the network, which makes it very difficult for attackers to attack that network. So in proof of stake, it is your stake which makes it really difficult for attacker. So let's say for Ethereum, it is 32 ETH, and you have uh, validators in thousands or millions. So for you to attack a system, you need to have 51% in your hand. So if you assume Ethereum's market cap is 500 billion, you at least need to have a 250 there, which makes it really difficult for them to attack the system. Now, you give your Ethereum for staking to secure Ethereum, but what do you get in return? Like, otherwise you can trade it or do some DeFi activities. So once you give your tokens for securing the network or validating the network in return mints a token, or they keep aside some rewards to distribute it to the stakers. So let's say there's a project who is launching their token, they keep 5% or 10% supply to all the stakers that are coming in. So once you stake your tokens, you receive 10% or 20% of tokens in a lifetime. So for Ethereum, the interest rate or APR is around 3.3%. So you stake your token, and based on the network activity on Ethereum, you get your reward. Like, you get 3.3% of your rewards, but how much is minted depends on network activity. So for the most part of it, after Ethereum started POS, it has been deflationary, which implies there is huge demand, but the validators are sufficiently doing their job. So it is deflationary. If there is not enough interest on the chain, it will be inflationary, where the minting is high, but the usage is low. So similar to that, any network who is launching their own POS, they have to create their own pool to distribute tokens, rewards, and then and differs. Most of the factors that affect this is total amount staked. So if you have higher total staked, which means lower individual rewards, and I mean, if you see any network in general, their stake percentage maximum, I would say, is 50%, because that's the sweet spot as of now. Ethereum, I think, is hovering around 39 to 35, so there's still a lot of scope to um, improve in terms of staking there. And you have
Mm.
inflation rate, which determines number of new tokens that are distributed every epoch or every block, whatever the project calls it. And your validator performance. If your validator is performing to all the parameters that I was speaking earlier, high uptime, minting blocks, reliability, they earn more. And last thing is all the network parameters that are there, which will impact staking reward. Like for Ethereum, you have block time of 12 seconds. So every 12 seconds, you propose a block, you receive rewards. For Solana, let's say it's less than a minute, or sorry, less than a second. So
Mm.
it depends.
Nevertheless, the interest is growing. There is also innovation in the field, such as restaking, for instance, and we touched upon this a little bit. Like, can we recap what restaking is, and also what is the implication of restaking on the industry?
I love the restaking idea in general, right? Like you you have certain limited stake with you, like certain limited money with you. What you can do with that money is, let's say I buy Ethereum, I stake Ethereum. But what if you want to participate in all the decentralization, or you like other project but you have limited money? What do you do? So that is from the user side of things. But if you see from project side of things, once you set up or create a project and you want to decentralize it to POS, first thing you want to do is have good sustainable validators, and have certain rewards chalked out to them, but then it is aligned with your project's token price, or or otherwise, if you decide to give out ETH, you have to spend a lot of money to just give it to them. So to bootstrap your network, you borrow security from other networks. That is the concept of restaking. So for Eigenlayer is the first player to do that on Ethereum. So you stake your ETH. Eigenlayer will take that responsibility to manage all this math behind it. But you stake your ETH, and then you have an exit address, which is, let's say, if I stake ETH myself, my address is exit address. But you give your exit address as eigenlayers, and on Eigen platform, you choose which projects you want to support to secure which projects. So along with ETH, my ETH is also securing, let's say, EigenDA, let's say, two or three other projects. So here, but the downside risk here is if that project decides to slash me for any reason. So it's I see restaking as a leveraged ETH option. So on ETH, if you stake your ETH, you're only responsible for receiving rewards on ETH, and your downside is slashing risk on ETH. But here the upside is you provide security to multiple projects. You receive rewards from all projects. So that's the upside. And downside is, if your validator is not doing good, everybody slashes you. So Ethereum will slash you, Eigenlayer will slash you, other projects will slash you. So the downside risk is also high, but then it's up to you to choose your risk appetite.
And if the risk is higher, what about the reward? Is it the same as in overall staking, or is it different?
Now rewards are absolutely high because I have one ETH, which earlier I just used to provide security to Ethereum, but today I'm giving it to Ethereum, let's say Eigen, Celestia, and four or five projects. So I will receive rewards from Eigen, Celestia, which I can use to cover my running costs, operation costs, or book profits. So you have multiple projects. So it's important to choose which projects you provide security to, because unless the project is reliable, you tend to lose most of your money there, right? Like each project slash you multiple times for unnecessary reasons. Like it is the responsibility of project to define slashing rules also. So slashing rules play key role for validators. So if the slashing rules are, if slashing rules are, you know, very, I mean, if they have tens or hundreds of rules, you tend to miss a couple of them easily, and then you get slashed. So
Okay, and we talk a lot about Ethereum, obviously. But now there is a growing interest in Bitcoin, which traditionally used the proof of work. So how does that work, and how does it affect overall, staking environment?
yeah, so Bitcoin, as I told you, it's a proof of work, so you can't change the way in which it works. But what you can do is borrow Bitcoin security and try to provide security to other chains. Or you try to stake your Bitcoin, as in there's no staking smart contracts on Bitcoin, but you there's a project called Babylon which came up with similar strategy where you give your Bitcoin to a single address through scripting on Bitcoin, and then they provide that security value to multiple POS chains. So you receive rewards on those chains, and and then you have your stake Bitcoin anyways. If you want to withdraw, you can withdraw. But because you can't mint new Bitcoins for the staking, there's nothing called direct staking on Bitcoin, but staking comes through an indirect means. But if Bitcoin comes into staking ecosystem, then I see there'll be a lot of good adoption coming in, and then POS, or staking as a whole will take a different landscape from that.
And can you unfold a little bit more this you borrow security? What does that exactly mean?
If you launch your project, you want to have the 51% attack as costly as possible so that nobody can afford to attack your system and take control of your system. So in POS, when somebody has 50% of your staked value, they can still attack your system. So you want to have that staked value as big as possible. But will your project, which is very new, will have a very big market cap that is not affordable to anyone? Let's say I launch a project and the price of token is not in my hands, it is in community's hands. So if my project is doing a 5 million 5 million in market cap, you just have 2.6 million with you and you can vampire attack my system. Versus if you borrow security from Ethereum, all the stakers in Ethereum, if they try come forward and provide security to my network, even if 1% of Ethereum provides security, it is much more than my market cap, which does not incentivize anybody to attack my network.
Let's jump into a slightly different topic then. And can we talk a little bit about the challenges of running staking on multiple chains simultaneously?
You can still do it as in so if you see that from validator's perspective, it's just a single machine you have, so you can share it across multiple projects, but it comes with a bit of security risk, right? Like if your system is compromised or one of your software that you're running is compromised, it gives an entry point into your system, and then whole of the other keys are also at stake. So when you run a validator, although there are new ways to mitigate it these days, but you tend to store your validator keys somewhere in the system. It can be local storing for just the project, but it gives an entry for attackers to attack your system. So I would say running simultaneously within a system is not encouraged, but yeah, otherwise you can still go and do it.
Mm.
So the eigenlayer that or the AVS that I was speaking to also comes with that slight risk of running multiple things. But again, as long as it is audited, then I don't see any problem in doing that.
Okay. Now let's maybe talk a little bit about components of staking infrastructure, particularly oracles, and we can unfold some other components too, maybe that are important to highlight. But with Oracle specifically, what role does it play, and how is it important, especially in complex staking arrangements?
Oracles is, I mean, again, one of the most Oracles had their own share of hype in previous cycles, but then they still play a crucial role. It's not like because of price action that you see on Chainlink or any Oracles, it's not like the hype is gone, but you still have that importance in traditional infrastructure. So Oracles provide external data to smart contracts. So smart contracts being the core strength to any blockchain. Where do they get their data from? They don't speak to internet for everything. So you have smart contracts who feed in data. So oracles feed in data, which is very crucial to staking protocols. So they enable decentralized price feeds, which help them to calculate all the staking rewards or trigger actions like automatic rebalancing in complex staking arrangements that you have. So having oracles will ensure accuracy and efficiency in your cross-chain staking strategy. So Ethereum is a single chain staking strategy, but you might have a cross-chain staking strategies coming in where if you do something on chain one, you need to know that on chain two. How does this happen? Oracle will send that signal from one chain to other, or you need a way to send through its smart contracts, right? So that essentially is an Oracle. So Oracle is really important, and I see this. Uh, I mean, there's only one way of strengthening this. Otherwise, it's very difficult for staking to proceed without that.
And building infrastructure for staking is not an easy thing because, again, it has many components. So Oracle is one. What other components do we want to highlight as key important bits of the infrastructure that, well, can't be ignored?
So along with oracles, you have different staking clients, right? Like as in, if you take Ethereum, for example, you have different layers of staking that is happening. You have consensus rewards, you have execution rewards. So when I say consensus rewards, you have a software which is taking care of all the consensus that is happening. When I say software, you have multiple clients. Like if you just have one client, there is always a risk of that client having a trouble, or and having some upgrade issues. So you need to have diversified client. So once you have diversified clients, even if let's say you run three set of validators, each with a different client set, even if client A goes down or does not function properly, you can always fall back to client B. So it's important to have a diversified infrastructure. It can be running your software on different regions, like you run main software on region A, you fall back to region B for your disaster recovery. And clients are really important. You need to decentralize your clients. Having a good Oracle solution is important because of obvious reasons I quoted earlier.
Mm, mm, mm. Okay. Okay. Good. Um, and so we see the interest in institutional staking, and I wonder what are the key considerations for an institution when they choose a staking provider, and overall participating in staking, what does it imply for institutions and what are the benefits?
Institutions go very conservative approach in general. They do need that trust to be built right before they take any decision. Um, so for institutions to start entering into staking ecosystem, which they're doing now, they need to believe that the underlying infrastructure is robust. So you need to have an institutional grade infrastructure, having a bare metal server running, or having a disaster recovery setup, or redundancy that you have in whatever you do. So having that unique infrastructure setup along with having a regulatory compliance, you have different rules when it comes to staking in different parts of the world. So adhering to strict legal and regulatory requirements is something that they look for. And they also look for security, as I told. And they need to look for good custody solutions, because staking is a non-custodial thing. But where do you stake from? You stake it from a single wallet, or you stake it from a custodian. So the institutions prefer to stake it from custodians because they park their money in custody solutions. So it's really important for any institutional staking provider to give them solutions how they can stake from that custodian. So you need to have good SDKs where you can integrate, and they can just with click of a button they stake it to your platform and back and forth, right? That's really important. And last thing is scalability, because as you grow, they expect you to scale without any major hiccups. So if you have all of this and good auditing that is done, like you can get basic certifications like SOC, SOC 2, or ISO certifications, which will give them more confidence that you're running a more robust architecture. Yeah. So I see these parts as very crucial things for institutions to trust a validator. And then once they start earning rewards, then I think it's just a matter of time where other institutions flow in.
And this is a lot to consider. Are there any players, like is the market ready for this sort of demand? No wonder why financial institutions are so huge, because they have all of this covered, right? But with staking, it can even go global. It can even there are so many questions. Like, is the industry ready for this, or is it still in the shaping stage of it?
We are not in early stage. We are almost there where institutional players can come in. I mean, you have all the necessary infrastructure, which is evolving by day, but that doesn't mean the previous versions that you're using is not institutional grade. So I see, if you have an open source smart contract. So what major risk do you see for institutional players? If it is a non-custodial staking, the moment they don't trust, they click exit and then their tokens fly back to their wallet. But what risk do they have? Once they trust a validator, delegate their tokens, validator should perform absolutely fine. And the tokens that they have or the rewards that they get um, flow from a smart contract, right? Like Ethereum mint some tokens, they send you back, or the staking smart contract that is there should be robust that so that none of your stake tokens are affected. So if you have proper auditing to that smart contract, and if you open source that smart contract so that anybody across the world can submit any bugs that they see. So if it is battle tested well enough, I don't see any issues where um, there is any better place. Like if you see current banking infrastructure, you still have a lot of loopholes, but it is still evolving. You fix the problems and move on. So having an open source smart contract, I think, will solve majority of the issues here.
And there are certain institutions that are a little bit more advanced in tech, and they're also adopting Web3, and there are certain institutions that may be on the verge of it. So for them, what is the benefit of investing in particular, like engaging into staking rather than in a more traditional type of investment?
The reason why you choose blockchain for your investments is, either if you believe in technology of decentralization and everything, or you see the returns that blockchain give you. So either way, you buy a project token or you take position into a token in open market. But what do you do with that token? You either park it in your custodian, which does not give you any yield, versus you stake it with your staking partner and start earning some yield. So I prefer rather way. And I'm sure all the institutions do that because nobody wants to see their money sitting idle. So they do want to earn some yield, but not at the risk of losing everything. So that is where all the pointers that I told earlier comes into play. You have to have a battle tested smart contract for the network. You have to have a very good validator who is SOC or security compliant, running robust infrastructure, and then they're good to go with earning more yield.
Okay, thanks. And let's look ahead a little bit. Do you see any particular trends or emerging technologies or anything noteworthy that is coming up?
Now, I think more or less, if you see staking in general, you have liquid staking, restaking that is there. So I see major trends improving in these sectors, in both liquid staking and restaking, improving both capital efficiency and flexibility in how you do these things. Like if you have multiple players doing liquid staking, all the liquidity is fragmented. So you want to solve that fragmentation issue, capital efficiency issues there. Um, so I see interoperable solutions kicking in. So now you have Ethereum supporting staking, you have multiple chains supporting staking. So you have multiple chains, but you want to have some sort of communication between all of this. So that's where interoperable solutions come in. And then I see institutional adoption kicking in more uh, emerging trends here, like more institutional adoption coming in, more sort of funds come in, like ETF is an example of that, right? Like ETF traditionally originated from institutional players wanting to have exposure to multiple assets at a time without having too much risk. So, and then you have multiple layer twos kicking in. So I see layer two staking taking a big chunk of what is there in the market now.
Since you mentioned ETFs, you did talk about this before we started the conversation, comparing crypto and gold in post ETF. Can you unfold this a little bit?
If you see gold after the ETF announcement, so ETF gives a way to leverage your position or buy take a position into the pricing action of gold. So that gave people a good opportunity to buy gold ETFs, bet on gold. And then if you see the graph of or the chart of gold post ETF announcement, so it's been up only, if I can say in crypto language. So it's 4x or 5x since ETF announcement. That's not just because there's speculation. There is uh, grown interest after ETFs. Like many people who cannot, you have unlimited exchanges now, but you barely trust few exchanges. But ETFs gives you that security where there is an underlying asset actually backed, and then you can also diversify your risk. So Bitcoin gives that now. Now Bitcoin and Ethereum ETFs are announced. There is absolutely so I would say the initial few days, if you see, the interest is amazing. Like there is a lot of institutional interest in the market. So I see Bitcoin adoption kicking in by general players. Everyone who want to buy Bitcoin, they can approach these players who are already there in the market providing ETFs. And then I see Bitcoin interest soaring in, and of course, eventually, I believe personally that price will follow the lead.
And if we were to give a short crypto market overview, what's going on now? How do you see it?
I don't bother much about short-term fluctuations that happen in or price fluctuations, but the adoption has been great. If you see the ETF products or the products by banks that are offering Bitcoin, they are kicking in. There is institutional interest, there is retail interest, and if you see the products that are being built, DeFi or the liquid staking, restaking, or the kind of layer ones that you see today with you know sub-second finality or specific sector layers that are being built. So the work is being done. There's no nobody's just seeing price and getting bothered about what's going to happen. Even if you see otherwise, just the price action, it's still doing great. So I see very bright future for crypto in next coming years.
Okay, and just for everybody who have been listening to this and might potentially asking them, oh, ETF, what's ETF? And ETF stands for.
ETF, I mean, it's an exchange traded fund, or you can have your own name, but so there is an exchange or an institution who is offering you a product, which so if you want to hold just Bitcoin, you can buy it from exchange. But if you buy an ETF, you can reduce the risk. ETF can be blended of multiple products, so that's why the name exchange traded um, fund. So you have multiple people giving their own ETF products. They take license from government and they launch their products. Um, so as in you buy, I can still offer an ETF with 50% blended Bitcoin and a different asset so that you diversify your risk. So that's how ETFs work.
Hmm. Hmm. Okay. Um, so what we do in this podcast as well is we are taking people out of the comfortable zone where they're working, because there is no way otherwise to get to this level of details, to this sincerity, to this devotion, rather than taking somebody out from a company who is on the cutting edge of building technological projects and just talking to them. So I'm eternally grateful for you to join this talk, and that's very, very helpful for everybody else, because they get the first hand. Usually there could be a media person or anybody else who is presenting this, and there's and quite a bit of essence lost in this transfer of information. So I'm very grateful to you here. Maybe you can explain a little bit of what you actually do in a day-to-day work, and what project are you working with?
Yeah, absolutely. My pleasure, speaking on all of this, because it's really easy for somebody to get misguided in this world, where there are unlimited scams going on, unlimited misinformations going on. With AI kicking in, you really can't trust what is true, what is not. So it's important to give good guided information. That's what I believe. Um, yeah, I mean, I feel staking is the next big thing. So, I've been working on running a staking business inside Gateway Group. So it's called Stakeway, and we do run institutional staking for majority of the protocols that are there in the market, and we do it with most best accuracy that you can see. So with over a billion AUD, when we have barely started, like we started around 8 months back. I think um supporting multiple networks already, like Ethereum, Solana, Near, Bitcoin. So I see ourselves doing that, and I really encourage people. We are not just for institutions, but we provide institutional grade security or infrastructure. So if anybody needs any staking advice, or although it's not financial advice, it's just the staking advice. So feel free to reach out to us.
And how do we reach you out?
They're on LinkedIn, Twitter, Telegram.
Hmm.
I mean, all channels up. I mean, if you don't find us anywhere replying, drop a message to Gateway Group on LinkedIn or Telegram, and we are there.
Hmm. Hmm.
Yeah, but Telegram being the most active for crypto community, I would say reach out in Telegram. But even otherwise, there can be a day delay, but you get your response elsewhere.
Good, thanks. I think then I ran out of questions, and if you have any closing words, please go ahead.
I just want everybody who is involved in crypto to come forward and explore different things that are there here. It can be staking, ETFs, or if you want to play your hands dirty, try out DeFi products, which are regulated, of course. And it is interesting. So start with small, explore everything, and then if you need any advice, we are there any point in day. So you can reach out to us, and we'll help you in any way we can.
For everybody else listening, I would love to encourage you to put in the comments below any certain topics that you heard about and you want to unfold a little bit deeper. We can always do that. Otherwise, huge thanks, Srikanth, for coming and explaining everything so thoroughly and so coherently. I really enjoyed the talk, and yeah, thanks very much for that.
No, likewise, pleasure is all mine. Thank you, Dennis.